Look around any major city, and you'll see the monuments to a handful of companies that run our daily lives. We rely on them to commute, eat, and communicate, driving their market valuations well past the $500 billion mark. By every traditional metric, these tech giants appear to have won capitalism. They've captured enormous loyal user bases and achieved a scale that past corporations could only dream of. But if you peel back the quarterly earnings reports and look at the core operations, you find a massive leak. Despite the soaring stock prices and constant usage, these businesses are hemorrhaging cash at an operational level. Total market dominance is actively masking a continuous multi-billion-dollar deficit. To understand how this happens, we need to look at unit economics, which is a way of measuring the profit or loss of a single customer transaction. This diagram breaks down what happens when you book a ride or order a meal. It shows the revenue you pay minus the actual cost of the driver, the software, and the logistics. And right at the bottom, there is a glaring negative number. Every single time a user clicks, orders, or engages, the company pays out of pocket. Multiplying that single tiny loss across millions of daily transactions creates a massive cascading corporate deficit. In any normal business, selling a product for less than it costs to make is a guaranteed recipe for bankruptcy. Yet these companies actively lose money on every single customer they serve, while simultaneously growing into the most valuable financial entities on Earth. This massive annual deficit represents a calculated and aggressive boardroom strategy. This chart plots out how it actually works. You have the high flat actual cost of the service at the top and the artificially low consumer price at the bottom. The massive gap between what you pay and what the service costs is explicitly filled by billions in venture capital. By offering deep discounts, constant promotions, and free deliveries, they make the service financially irresistible. As that investor-funded gap grows, user adoption skyrockets. This cash burn serves a singular purpose: purchasing overwhelming market share. Running a deficit becomes a weapon, a heavily subsidized moat designed to capture an entire consumer base before anyone else can. Now put yourself in the shoes of a traditional local business trying to operate in this exact same space. You face an impossible math problem. To keep your doors open and pay your staff, you have to generate an actual profit. You physically cannot match prices that are artificially subsidized by Silicon Valley. The tech giant uses its endless runway of investor cash to turn the entire market into a war of attrition. They can afford to bleed capital for years, fully intending to outlast smaller competitors who inevitably run dry and fold. By deliberately starving the competition of viable pricing, the giant becomes the sole survivor in a market it now completely controls. Eventually, the music stops. Investors demand a return on the billions they poured into that moat, forcing the company to pivot from aggressively growing its user base to aggressively extracting cash. Economists call this monopoly rent. Once all the viable alternatives have been driven out of business, the surviving company gains the power to dictate the terms of the market. This diagram shows what that looks like for the consumer. As market competition drops to zero, the squeeze begins. Prices jump vertically, surge charges become the norm, and the generous early adopter perks quietly vanish. There's also a secondary hidden cost. The app gets clunkier, the customer support disappears, and the service degrades. Since they no longer have to compete for your loyalty, they no longer have to spend money maintaining quality. That early era of cheap, magical convenience abruptly ends the exact moment